Good morning. For those of you who don't know me, I am Nikhil Rathi. I'm Chief Executive of the Financial Conduct Authority. Thank you, Bruce, for those remarks, and Miles for the invitation this morning. And in particular, Bruce, congratulations on your tenure as Chair of the Leadership Council. It's been a pleasure working with you, and I've sat through some of your speeches, and that's the nicest one about the FCA that I have heard. So, leaving on a high, that's wonderful. I hope Anne can match it. Now, it's that time of year, students finishing school or university wondering what direction next. We're just through our own period of reflection at the FCA, working intensely with you on our new 5-year strategy. Miles, I was in Shanghai. They're on their 15th 5-year strategy, I heard last week. So we've got a few more turns of this to go. And from personal experience, deciding to stay on into a second term as chief executive involved a few hours of thoughtful mirror staring. So whoever you are, some days reflection is energizing, some days it's unflattering, but it's always revealing. So as we intensify our work to drive competitiveness and growth, we need to take a long, hard look in the mirror as a regulator and as an industry, warts and all, contemplating what we see today, but crucially, what we want to see looking back a few years on. What kind of market do we want to be? Now, the government's industrial strategy aims for the UK to be the world's most innovative, full-service financial centre by 2035. Now, Bruce, I don't know if HS2 will be done by then, but I'm sure we can achieve together that ambition for the city and all of the financial services industry across the UK. Financial services contribute 214 billion gross value added to our economy. We have world-leading banking, insurance, derivatives, payments, debt, foreign exchange, commodity markets and infrastructure. We lead Europe in fintechs, second only to the US in investment management. So this is a market with real reach, depth, purpose, exceptional talent. So let's not rose tint the mirror though. There are challenges. The interconnectedness in markets is amplifying shocks. International standards, the bedrock of UK wholesale markets, are becoming harder to sustain and agree. We will have to make choices and won't always be aligned with key partners. And of course, international competition is accelerating with multiple credible alternatives across time zones. So we cannot be complacent. We need collectively to move much faster and to execute better to stay ahead. The good news is that things are not as bleak as some headlines. The Global Financial Centres Index shows London closing the gap on New York, with Edinburgh and Glasgow also making notable gains. Financial services exports are up 50% since 2019, and investor demand for UK assets is growing. Many UK financial company share prices are close to multi-year highs, and the Treasury successfully exited its NatWest holding recently, and as I understand it, attracting buyers not just from the UK, but from US and Asia onto the shareholder register. So although we shouldn't fall into a Narcissus-like trap of self-admiration, we shouldn't relentlessly talk the UK down either. If we keep telling ourselves and the world that London has become second-rate, that risks becoming a self-fulfilling prophecy. So I believe this is the moment to reset the psychology, put aside British modesty and celebrate our raw strengths. Then make sure we go further, building consensus about what this entails, including our approach to risk. Wholesale markets with high integrity will undoubtedly remain key to our success. Take Applied Nutrition, a homegrown business, listed in October, reaching a market cap of just over £1/3 of £1 billion, or the 23 significant transactions by existing listed companies using the streamlined process following our listing reforms last year. Prime examples of the market providing capital and liquidity for growth, a springboard for exports and jobs. If we want more stories like this, we need to champion the conditions that make them possible. And that's why the FCA has shifted towards outcomes-based regulation, a focus on purpose, not process, more flexibility to keep pace with rapid innovation, and a stronger culture of accountability underpinned by the senior managers regime in the UK, which enables us actually to avoid writing new regulation. All long-term competitive advantages, I would say. So that's strategy. What about tactics? Tuesday marked 6 months since the Prime Minister's Christmas gift, or Christmas card, I should say, when he asked us at midday at Christmas Eve to come up with ideas on growth. He's in the building today, I gather, as well, launching the strategy on trade. And he challenged us to embrace that agenda, and that's something we've enthusiastically embraced at the FCA. We responded with nearly 50 proposals, and I know some of you have been surprised at just how quickly we have acted, scrapping redundant data returns and outdated supervisory communications, unlocking flexibility in the mortgage market, launching Pisces, a new venue for trading private shares, and more is coming. A consultation on reducing frictions for securitizations, prospectus reform to make it easier to raise capital, an imminent announcement on targeted support and simplified advice, helping more people out of cash and into investing in markets so they get better long-term returns. We're also changing how we work with you. I hope you've noticed our increased engagement with analysts and investors. At a recent AI roundtable, we actually heard very little by way of requests to streamline regulation. Instead, firms are asking us to work more closely to build confidence, understand consumer response, and scale safely. Our AI lab, our partnership with NVIDIA on a supercharged sandbox, will provide a safe space for firms to test market-facing AI applications, part of a broader shift towards a more open, collaborative relationship between regulator and regulated, built on trust, shared problem-solving, and proportionality, so we can win the race for the adoption of innovation. Let me talk about two areas where this collaboration is particularly important: risk culture and data. The FCA has repeatedly faced criticism for being too risk-averse. When I became CEO 5 years ago, a central theme was that we were too legally risk-averse, not curious, not assertive enough, not taking on firms when we should do, not joined up enough. So we've since made big changes: the consumer duty, stepping up the fight against financial crime, and taking several groundbreaking legal actions. In the process, we've brought the industry compensation levy down to a 10-year low, supporting competitiveness. Today, the risk aversion critique comes from a different perspective, that excessive regulatory compliance and perceived lack of commercial nous stifle growth and innovation. The Chancellor sees the regulatory system as having regulated for risk, not growth. So we're engaging seriously with this feedback and will continue to make changes at pace. And one of the reasons I've consistently called for an open debate on risk appetite and metrics for tolerable failures alongside metrics for competitiveness, growth, and operational performance is to ensure that as we shift to this stance, it will endure over time. We want a stance that gives firms and consumers long-term confidence to invest while building greater coherence between government, industry, parliament, and regulators. Take mortgages. I have raised with the Prime Minister and the Chancellor the Mortgage Charter. It was designed for a period of sharply rising interest rates. But could it now be retired? With the duty in place, repossessions low, and a maturing risk mindset, do we need this duplicative approach with the added reporting burdens it brings? So as we at the FCA review the mortgage market fundamentally, what signal does it send about political risk tolerance if the Charter is retained? We also hear arguments about further differentiating regulation for wholesale and retail markets, although many also argue low retail participation is a missing ingredient for success in our capital markets. We're open to clearer client classifications applicable to investment firms, though some of the fixes would require legislation. Again, if we do shift the boundary, it needs to stick politically, and it needs to stick in Parliament. That means widespread acceptance that some may have fewer protections than today. We're changing insurance rules to be clearer where the consumer duty applies, making it easier to serve overseas clients. Another area where trust matters most is on data. We're taking a more proportionate approach to data we ask for. 3 regular data collections already switched off, benefiting an estimated 16,000 firms, and a consultation this summer on retiring more. But in some areas, the opposite is true. We need more data and faster. I spoke in October about predictable volatility, now a fixture of global markets. We saw it in the LDI crisis, we saw it in April, and it's a matter of when, not if, the next shock comes. When it does, we need to be ready and informed. Hedge funds are now important liquidity providers in fixed income markets, behind an estimated 27% of weekly dealer-to-client trading in UK gilts. Visibility of this activity matters for us all. We will always be open to growth and competition, new players, new models, but that openness has to be based on a clear view of the risks so that we safeguard market integrity and confidence, crucial foundations for growth. And we will need to build data sharing beyond our borders too, with offshore OTC activity in sovereign debt markets also impacting our own market integrity and confidence. And you'll hear from Sarah Breeden later, no doubt, from the Bank of England. This is an issue that dominates our discussions at the Financial Policy Committee and in international fora as well, where we have led work globally. So what kind of market do we want to be? It's not just a question of systems, it's also about standards. And these are being debated more vigorously than I've known for quite some time. And being candid, there is money to be made in looking the other way and by turning a blind eye to dirty cash. We've seen that movie before. But is that really the at any cost kind of competitiveness we're seeking? When we sanctioned Credit Suisse over the Mozambique loan scandal, that was a real act of accountability. $1.3 billion of loans tainted by corruption. Millions of people pushed deeper into poverty in one of the world's poorest nations. Could we look ourselves in the mirror in 5 years' time if these were the costs of competitiveness? The FCA responded decisively there, banning 3 Credit Suisse employees for their lack of integrity and reaching a global settlement worth around $475 million. And we want to support innovation in crypto markets, and we've been cautious at times, not because we're technophobic, but because crypto remains the second highest money laundering threat on the UK's National Risk Register. A very real and growing terrorist financing risk too. So our regulatory framework needs to support innovation with guardrails. And so we're being bold to support change, innovation and growth. But let's not confuse that shift in risk appetite with compromising integrity. So where does the UK go next? I mentioned earlier that we're the largest fund management centre in Europe. Could we lead on tokenisation? The average age of an investor in an authorised fund is 55. I'm getting closer. But younger investors want a digital-first experience. Apps, instant trading, 24/7. And that's one of the reasons why they're attracted to stablecoin and crypto, and perhaps not as much to equities. There is huge potential for the UK in this area, but it will require investment from all of us. We're working with industry, the Investment Association, the Monetary Authority of Singapore through Project Guardian to develop proposals for cross-border fund tokenisation. An example of how we've long played a central role in shaping global standards and developments, and that won't change. But in today's world, we must supplement our approach with stronger bilateral relationships. We heard about the recent trade deals, and I would particularly mention the Berne Agreement coming into effect next year on financial services. We should be ambitious as to how we partner with our Swiss colleagues about making the most of that agreement for this industry. We're already taking action. We've posted a director in the Asia-Pacific region, as well as colleagues in Washington and Brussels to help identify and realise opportunities, with more to come. I opened with an important question. What kind of market do we want to be? It's one we must all ask and answer together. We've looked in the mirror and seen some challenges, but also real strength, deep resilience and huge potential. So this is a moment of opportunity for the UK, a chance to build on what makes us distinctive, our talent, openness, integrity, and to do so with purpose and ambition. The FCA will do its part working at pace to keep markets clean, connected, confident. So bring us your ideas. Keep challenging us to do better. Share your insights, because how we answer that question together and execute at pace will define the UK's future in global finance. Thank you very much.